All attendees are in listen-only mode.
Okay, go for it, Alex.
Yeah, here we go with the June edition of the Biznews Global Share Portfolio. My goodness, what a rocky ride we've had over the past month. The good news is that the portfolio has held up very well, relatively speaking. The bad news is the shock absorbers after the Brexit exit were not in play. We took quite a hit on our Barclays share that we only bought 2 months ago, but it just shows you just can never, ever tell what's around the corner for you in investing. And I guess that's a good lesson for anybody when you make your investments into a share portfolio. The unexpected does happen quite often. Let's just quickly go back on the Brexit shock and why it has taken the international markets by storm in the way that it has and knocked down the S&P 500 index. In fact, up until a month ago, up until a week, just over a week ago, the S&P 500 index was tracking 2.5% higher for the past 12 months. It's now down 2.7. So there's been a 5 percentage point drop in US dollar terms in the S&P 500 index. If you happen to be invested there in pounds, you would have taken a 15% hiding if you consider that the pound has dropped by 10% since Brexit. What happened? Well, the polls suggested that it was going to be a close run thing. The inside information that I had from the Brexit, from the Remain camp, in other words, those who were wanting the Britain to stay within EU, said that they expected to win it, but it was going to be very, very close. They were nervous. But the bookmakers had actually predicted a very comfortable win for Remain. As it happens, the bookmakers are horribly wrong, but just to put it into perspective, if you'd taken a bet on Remain just before the election, before the referendum closed, you would have got 27 times the profit that was being offered on a bet to exit. Why were the bookmakers so wrong? Well, in the aftermath of all of this, there have been all kinds of post-mortems, and I spoke to Dan Brockelbank, who is one of the top guys at Orbis, that's the Alan Gray international operation based here in London, and Dan said, of course, the penny dropped afterwards if you consider that the money that was being bet on Remain came from asset managers, no doubt, hedge funds, people who've got quite a lot of resources, whereas the money that was being bet on exiting or leave were lots of small bets. So you had on the one hand big volumes of money coming from relatively few bettors, and then a lot of small bets on the other side, which was clearly not going to be able to swing the money volume. But when they go into the polling booths, of course, everybody has one vote. So the Remain camp were hugely outnumbered when you look at the number of physical bets that were being placed. But on the other hand, the volume of money that they were throwing at it was higher. So we live and learn. The last election, when the Scots decided not to leave the Union, that was the UK, at that stage, the polls got it all wrong, and so, as they did in the last British election, but the punters got it right. This time around, the polls were a little more accurate, and the punters clearly, or the odds were all over the place. So that explains why the betting odds were so wrong, and why there was such a shock in the market, because what happened this time around, because in the last 2 political events, the markets followed what the odds were saying, and the odds, as a result, did not prepare investors for the drop that we've seen of 10% in the pound and the sharp drop in the FTSE index. Of course, the hardest hit in this situation are banking shares. They were hammered, and we have the misfortune of owning a banking share in Barclays PLC, which, as you'll see when we get into the portfolio in a moment, was the one of the hardest hit of the lot. It bounced back 6% yesterday, but it's still more than 20% off where it was ahead of the referendum. Why is that? Well, because a lower pound and higher interest rates are not necessarily good for banking shares when you overlay a weak economy. High interest rates are not bad for banking shares generally, but when you overlay a weak economy, which means bad debts go up, and not a good thing. So what we need to do in this kind of a circumstance where you have these external shocks is to go back to basics. And when you go back to basics, what is it that Warren Buffett would be recommending to us? Well, he'd be saying, before you buy a share, turn off, or imagine what happens if you turn off the stock market for 5 years, maybe 10 years. So if you were to do that, when we have a look at the other requirements, you've got to understand the business. It's got to have favorable long-term economics. It's got to have able and trustworthy management, have or possess an enduring moat, and trade at a discount to its intrinsic value. You add all of that together, and when we apply Barclays, i.e. some people are now saying, my goodness, you bought Barclays 2 months ago. Should you be panicking and selling it now that it's down by 2%? Well, definitely not. In fact, it's looking like a fantastic buy right now, because go through all of it. In 10 years' time, will Barclays still be around? Well, it's been around more than 100 years, so almost certainly yes. Do we understand the business? Yes, it's mainly a retail bank in the high street. Favorable long-term economics? Definitely. No matter what is happening in the payments environment, and fintech is starting to disrupt quite aggressively around the world, this is still a business that is based primarily in a country where people don't change that rapidly. There's a lot of regulatory protection as well for banks in the UK, and they're in the business of borrowing and lending, and that's never going to go out of fashion. Able and trustworthy management wasn't the case, but when John McFarlane took over as chairman and he put in James Staley as the CEO, it ticks that box as well. Does it have an enduring moat? Most definitely. Barclays is a high street bank in the UK. It has a very strong brand. And in this country, and I'm talking to you from London, of course, that's why I say this country, the turnover of the retail market is only 1%. So in a year, you would have banking accounts that are held by people in Britain in the retail market. Roughly 1 in 100 would bother to change their banking accounts. You'd think it would be much easier to get them opened. Well, it isn't. It's a tough thing to do. But certainly they don't change their banking accounts, and that means you've got an enduring moat sitting at Barclays. Intrinsic value, the final sixth point, Barclays shares are trading at the moment at 131p. They got down as low as 124 pence a share. They're down 29% at the, right now from where they were trading before the Brexit vote. That is a discount, a massive discount on the tangible book value, which depending on where you look at it, in their balance sheet, it's 275 pence. When you reduce the tangible book value even more, in other words, that's your real underlying net assets. If you were to liquidate the bank today, pay back everybody that is owed money and get in all the money that you are owed, you would have a price to book here of where the shares are trading right now of 0.67%. So if you were trading at tangible asset value, you'd be trading about a third higher than where the shares are at the moment. Price to book of 0.67. That's a massive discount. There's a margin of safety there. There is all the other boxes are ticked. This is a stock that, in the wake of Brexit, should be right on the top of your buying list. Is Brexit actually going to happen? Well, of course it is, but not going to happen without a struggle. The British public have voted 52% to 48% to leave the European Union. Financial Times of London today, Gideon Rachman, who incidentally has a South African heritage as well, he said, and he argues this very well by saying it's not the first time that you've had a referendum that's gone against the European Union. In 1992, Denmark rejected the Maastricht Treaty, and in 2001 and 2008, Ireland rejected the two proposals that the European Union had put forward, all in their first referendum. As a consequence of the rejections, concessions were granted by the EU, and there was a second referendum in each case. So Gideon is arguing that the Brits will possibly be allowed a second referendum. And it's it's a cogent argument, and one that is shared by many people, including those who are watching the probable next Prime Minister of Britain, Boris Johnson, who incidentally was a journalist at the time that the Danes voted against the Maastricht Treaty, and he was a journalist employed in Brussels at the EU. That was in 1992. So he's seen this kind of thing, this movie, from the front row. But on the other hand, the problem with that thesis, one feels, is that the French, the Austrians, the Scandinavians are all in polls ahead of Brexit, that all of those polls were suggesting that that they wanted to get out more than the Brits wanted to get out. So when you're looking at where the EU is sitting, it becomes a very, very interesting situation in all of in whether Brexit is going forward or not. Whatever, we have we can only work with the market as it is today, and the reaction or the knock-on effect of the British decision to leave the EU has to create uncertainty. Markets hate uncertainty. The pound is down from $1.50 just before the referendum. And incidentally, the final exit poll that was done said that the Remain camp would win 52-48. The final result was the other way around. So the pollsters haven't come out of this with much credit. Just about nobody who was prepared to predict it, and there were lots who did that, actually got this one right. But London now was the one part of one of the parts of the UK, together with Scotland and Northern Ireland, which voted in favour of staying in the EU. It now wants more autonomy. There's all kinds of consequences that could come from all of this. The pound's down from $1.50 to $1.32. Imagine you're an American. You came to London, it would cost you $1.50 per pound. Now it only costs you $1.32. David Cameron's on his way to Brussels. He, of course, has resigned as well. The UK sovereign rating, and we know all about the decline in sovereign ratings in South Africa, that's been cut by S&P, the last one that had them at a AAA. Cameron's successor is due to be named on the 2nd of September. Corbyn, who's the official opposition, has had his shadow cabinet abandon him in droves, 46 resignations from his shadow cabinet. There's all kinds of controversy and turbulence, which the Brits are not used to. Remember, in South Africa has gone through great change over the last 20, 25 years. In the UK, there's been change, but it's been at the margins. It hasn't been an uproar like this has happened. So clearly there is lots to digest, lots of uncertainty, and we see the markets reacting the way that they have. When you go over the water to the United States, even there, the uncertainty coming out of Britain, and remember, Britain is, depending on the exchange rate, either the 5th or the 6th biggest economy on earth, that has had an impact, a knock-on effect in the United States, not least because people are now very seriously believing that Donald Trump could be the next president there, and with all that that implies. The Vanguard S&P 500 index in the wake of Brexit has fallen by 5 percentage points, and that means that after being kind of level pegging for most of the last 18 months since our portfolio has been running, it is now in negative territory. So if you've taken money in the United States, put it into the market generally, you would be down 3%. Our portfolio overall is up 7% in US dollar terms. So if you want to think about a bottom line number, we've outperformed the portfolio that we've put together and continue to stick with, has outperformed the market by 10 percentage points in those 18 months. And that is very gratifying indeed in these kind of troubled circumstances. When you go through the portfolio, it's very easy to see it hasn't been a even keel riding there. Alphabet, in which 1/3 of the way we worked it out was we put roughly a third of the portfolio into the Vanguard S&P 500 index, in other words, into the market generally, and then we split 15% each into Alphabet, or the old Google, Apple, and Berkshire Hathaway. Berkshire has performed in line with the market, as you would expect, because Berkshire is a broadly based industrial conglomerate. So it's down by 7% in dollar terms, but it's performed in line with the overall market, which is down by 3%. Nothing shocking there. Apple, on the other hand, has been a terrible underperformer. That's down by 26%, whereas Alphabet or Google is up 25%. So of the big three, one has performed with the market. Alphabet has offset the losses on Apple. So generally speaking, we really have a market position, if you like, for most of it. Where the upside has come in this portfolio has been through Amazon.com. And as you can see there, in US dollar terms, that's up 111% since we bought into it. It's our version of Naspers, if you like, in South African portfolios. It's been the tugger. It's been the one thing that's pulled the portfolio higher. And that's what stock picking is about. You try and find that one that shoots the lights out. And then very fortunately, in our case, we found that. Novo Nordisk has been a good performer, although like most shares around the world, came under pressure in this past week since Brexit. IBM has been an underperformer, but again, it's a value stock, so that is not really a worry to us. You can keep accumulating IBM. Value shares take time to realize their potential. And then you have Barclays, which was directly in the tsunami of Brexit, and that which we bought on the 29th of April at £1.74. It was sitting at nearly £1.90 ahead of Brexit. It's now down to £1.37. So those are the overall portfolio. Of course, this is in US dollar terms. What we need to consider as South African investors is rands. If you go back to the beginning of the portfolio, when we started the portfolio, it was a view. We took a view that the South African rand would be weak because the economic policies being followed by the Zuma administration were unlikely to lead to A, growth, or B, as a consequence of that, an appreciation of the currency. In fact, the currency is locked through bad economic decisions and strategies into a sliding decline. Thankfully not of the Zimbabwean nature, but it has been falling and is likely, unless there are some restructuring of the type that the Finance Minister, Pravin Gordhan, has called for urgently, but nothing seems to have happened. Unless there's that, the rand will continue to weaken. So that was our big bet. Our big bet when we started this portfolio in December 2014 was that the rand would weaken, take your money offshore, put it into the international market, and let's try and find stocks over there that will outperform the market generally. And by that criteria, we have to say that so far the portfolio has been a successful exercise. On the one count, the rand view has certainly come to fruition. As you can see from the bottom of the table there, when we started the portfolio on the 5th of December, the rand was 11.27 to the US dollar. After clawing back some of the recent losses, it's still at 15.20. That clearly, when you have your money in dollar-denominated assets, as we have here, makes a huge impact. As far as the pound is concerned, when we bought into Barclays, the rand was at 20.88 against the pound. It's now 20.23. So even after Nenegate, the rand has managed to claw back a little bit of that loss against the pound. Remember, pre-Nenegate in December last year, the rand was trading at 18 to the pound. It's now at 20 to the pound, but the pound itself has been the one under much pressure because of Brexit. When we then have a look down the far right-hand column, because this tells you whether or not it's been a sensible investment in taking the decisions that we did to go big into a global portfolio from December 2014. As you can see, Apple is, even in rand terms, has been a loser, and Barclays, of course, in rand terms, has been a big loser. But outside of those two, the portfolio is still up by 37%. Around 27% of that has been rand-related, and the total annualized return, when you take the 18 months and divide it really into 12, is 26%. So all round pretty good. Remember, though, that this is a portfolio that we are holding forever. If the stock market were closed today, we'd be quite happy that in 10 years' time, the companies that are in this portfolio will be in better shape than they are today. That's the intention of the investment. Getting into the individuals, there you can see the annualized return, clearly Amazon.com in Rand terms is a 184% or 123% annualized. But there's been some nice drops, increases there thanks to the Rand depreciation. Of course, Barclays and Apple, I would argue that both of those are offering massive value at the moment. And if you have a little bit of extra Rand that you're looking to put into the global markets, those would be the two. In particular, Barclays would be the two that you should be putting some of your money into. There we have, as far as the portfolio is concerned, it's a graphical exercise. You look at this and you say, my goodness, thankfully you had Amazon. How did you find it? Well, you need a bit of luck in investing, and the good fortune that we had in Amazon was not only in buying it, but holding on to it. And it also belies the argument that some people have to say that as soon as a stock shows you profit, you should be cashing in that profit. Well, if we'd done that, we'd be looking a little sick right now. What I can tell you from someone now living in the UK is that this is a world that is being Amazoned. It's incredible how often one would turn to online for your purchases. And if you do yourself a little exercise and go onto Amazon.com and have a look at what is available, rather than going in the traditional route, which we as South Africans have, where we go to the shopping centers and then browse around and feel something and eventually buy what it is that we think is good value after spending a lot of time. You can do that online very easily, and Amazon, through their Amazon Prime service, which has got millions of members, I've joined it as well. Not only do they give you free videos to watch and free music to listen to, but actually they will deliver your product in a day. It's incredible. That's why Warren Buffett had as much to say about Amazon in his Berkshire Hathaway AGM this year. I think he mentioned Jeff Bezos and Amazon half a dozen times, saying that they were a little late to understanding and appreciating that, but that the world is really being transformed. In the same way that Facebook has transformed the media world, Google has transformed the advertising world, Amazon has transformed the retailing world, and continuously eating away at the retailing operations. The only way to defend against Amazon, it seems, is to get bigger, faster, and that's why Marcus Jooste at Steinhoff has been expanding or trying to expand as rapidly as possible into Europe. You might remember, Steinhoff had 2 attempted takeover bids contested. They weren't complete disasters because although Steinhoff didn't get them, they made a profit out of that exercise. A profit, I think Marcus was telling me when I interviewed him 2 weeks ago, it was 40 million euros. That's not small money in anybody's terms, and certainly in South African rands, that's good money. But they've now had another run at a company called Poundland, which is based here in the UK. It would fit beautifully into PEP and the existing operations that they have in the retail market in the UK. And they believe that that's by being focused on the bottom end of the market and by getting scale quickly, they can offset the advantage that Amazon would have. Of course, on the other hand, you have to realize that they are trying to grow their online operations too, to deflect the Amazon effect. The companies that are really in the sights of an Amazon expansion, and it continues to expand rapidly, are those who would be the natural markets for time-poor, money-rich purchasers, and they would be the people who you'd see shopping online more often. So that's the numbers there. Let's go through the dividends. There was a dividend that came in from Vanguard, from the Vanguard S&P 500, 318 shares or units that we hold. There was a 95-cent dividend. It was paid another $300 added to the portfolio. And excuse me, I've been doing a lot of talking. The questions are open. So, Stuart, you still with us?
I'm still here, Alec. I have nothing yet. I think there's a cold front over South Africa. It's a bit of maybe some brain freeze around, but nothing yet.
I thought that only came from eating ice creams on Durban Beach, but anyway. I have been talking a lot about Brexit, etc., but we are now open for questions. So send them through. You just need to literally just type them up, and Stuart will stop me, and we can take them from there. It's going through the individual parts of the portfolio. Let's go to Vanguard. That is, remember, about a third of our portfolio is put into this. As you can see there from this graph, look at that, the most recent number. It was a sharp decline, similar to what happened, if you recall, in August last year, 2015. You can see the big drop there. Well, fortunately, not quite of the same extent to that. And then again, as we began this year, we had a really, really awful January. In fact, January 2016 was the worst year for shares on record. And the market clawed its way back up from being around 10% down after January to being 2.5% up just before Brexit, and along comes Brexit. So anyway, we now, the S&P 500 in the past year is down by 5%, which makes any growth on that pretty good going. Berkshire Hathaway followed the market down, not quite as badly, but it has been an underperformer for most of this year. My apologies, it's been an outperformer for most of this year. It's done better in 2016, but on year, it's still kind of aligning itself with the S&P 500 index. We bought it 18 months ago. Over that period, it's underperformed. But Berkshire's one of those stocks you put in your portfolio and you don't worry about. Alphabet, that's Google. As you can see, wonderful outperformance. The share price of our holdings is in blue, and the benchmark is in red. In this case, it's the NASDAQ. That's where Alphabet is listed. And as you can see, an outperformance there of 35%. NASDAQ having done worse in the past year than the S&P 500 index. In fact, twice as badly. Moving on to Amazon.com. In the past 12 months, it's up 60%. And it really started running a couple of months after we bought it in December 2014. It's interesting to see, because in January this year, the share price came down very strongly. And some of the thoughts were at that point that the FANGs, as they call them, Facebook, Amazon, Netflix, and Google, those four shares, which had between them pulled up the S&P 500 index for 2015. If those four companies did not exist, the S&P 500 index would actually have been down in 2015. That's the power of those four. Well, in January this year, there was a view that, and it ran through to February as well, that the FANG's days were over. We didn't think so, or maybe some of the others are, but we don't think that Amazon's days are over. And as you can see there very clearly, the stock has appreciated strongly since bottoming out in early February. So thank you to the FANGs. Thank you to Amazon. Stu?
Question from Yaku, Alec. He wants to know if you've got an idea of how long the market will take to heal from Brexit.
Yaku, there are assessments for the moment which suggest that the worst is over. And often that does happen. If you have a longer memory, you'll recall that these hits tend to come hard and quickly, and Mr. Market overreacts. And when we started off in this webinar to talk about the Buffett principles, turn off the stock market, or in other words, buy shares that you won't worry about if you turn off the stock market, that have got favorable long-term economics, you understand the business, able and trustworthy management, they have an enduring moat and intrinsic value. Those six. It's a similar thing when you think about markets generally, because their prices are not necessarily the value that you get. The prices are determined by day-to-day fluctuations in the mood, the way that investors as a whole perceive, and they don't always perceive things correctly. Mr. Market is a manic depressive. He panics and he gets over exuberant. In the wake of Brexit, there's no question that he's panicked. He's very much panicked over banking shares, and you would now find that it appears anyway that the panic is starting to quell a little bit. The banking shares have picked up a little bit from their worst levels. The pound is upped significantly from its worst level. David Cameron's going to Europe. The market is discounting the worst possible negotiating scenario and none of the possible upside, which could be in the UK, and this has been lost by many of the commentators. Those who voted to leave the European Union were the wrinklies, as they call them, the older people. And their argument generally, most of all, is that they went into a free market environment, and the free market that they voted for became a runaway train, which not long ago wanted to become the United States of Europe with one constitution for the whole of Europe, which they don't like. So the Treaty of Lisbon, that's really what the referendum was back then, which the Irish voted against, that was all to do with trying to bring Europe closer. Because if you're going to amalgamate all these countries, eventually you want a federation that is tight and includes everybody. Whereas the Brits are saying, and the island mentality possibly played here, the older Brits are saying, we actually don't want that. We joined you because you offered us a free market, and now you are saying you want to rule us. That's really what it all comes down to. And that's likely to see sanity prevailing because markets are driven by common sense in the end of the day. Mr. Market has very little common sense, and Mr. Market has overreacted. So I would say, Jaco, we might have seen the worst. It's very possible that we have. And if you were to be a follower of Mr. Buffett, then you would be saying this is the right time to be buying when everybody else is selling.
Alec, a question from Urina on the dividends. What do you do with them, the ones that are received?
In this portfolio, we put them into our cash holdings. So just to go back, Urina, we would not take the dividends out for any reason. I'll just take you back to the portfolio and you can see. There we go. If you have a look down the bottom there underneath Barclays, you have cash, and the cash holding in the portfolio, 3,234. At some point in time, we will reinvest that, but one of the disciplines we've given ourselves here is that we only make investments when you are with us. So I've been very keen on Facebook, and I've been toying for a while now with dropping some of the holdings elsewhere to reinvest that money into Facebook. But nothing has been strong enough, and certainly with the recent reaction of the market, to suggest that you should be shaving off some more money from some of the holdings. So what we would probably do is, as we did with Barclays, is reduce some of the stake in the S&P 500 holding there in Vanguard, and we would then take part of that and then use the cash that we have there. So invest that cash into Facebook. I'm just waiting for the right time, Jarina. But no, the cash stays in the portfolio.
Alec, question from Kirsty Thompson. She says she's got $3.5 million in cash. She's 44 and has no debt. Is now the right time? If so, into what?
Kirsty, there is no doubt that if you have rands, and that sounds like what your money is in, you need to be protecting yourself against continued decline in the value of the currency. And that is the reason why we started this global portfolio, and I still feel very strongly that that's the best way to protect yourself. So what I would do if I was in your shoes is I would replicate this portfolio, but do it progressively. Try to take out the impact of timing. If you were to put all of your money into these various stocks today, then you are taking a risk on two things. You're taking a risk on the markets and you're taking a risk on the currency. Rather stagger it. If you are comfortable over 3 months, that's probably okay. If you are more conservative, you can stagger it over 6 months. But it isn't a smart idea to just take a full punt at any point in time, because you then opening yourself up to the risk of market variations. We started this portfolio so that the clients of Standard Bank WebTrader, or in fact any South African, because WebTrader is a phenomenal product which allows you to invest anywhere in the world, it's to give you an understanding of what's happening elsewhere. It isn't a it's a model portfolio, if you like. You don't have to replicate everything that we have, but in the very the basic idea here is to make these investments. Then you start learning about it. We have tried our best to find the best possible investments that we can, and by doing this monthly update, it gives you an understanding of why there's been performance or why the shares have changed in the way that they have. The worst thing you can do is give your money to somebody else and then come back in a year's time and say, oh my goodness, what happened in this year? Whereas this way around, you are on a monthly basis, you are informed on exactly how your money that you've invested is performing. So that would be, I would suggest that you replicate this portfolio, but don't throw it all in at once.
Alec, LH has got an interesting question. Where can one get the best interest rate offshore instead of equity or bonds? I'm not sure it's a very easy one to answer, though.
It's an impossible one to answer because interest rates always reflect the risk. If you can probably get 5 or 6% in certain of the investments that you find, but they would be higher risk. The one I really like, and we've spoken about it a lot on Biznews because I did investigate it, is Quanta. It's a property portfolio run by a South African. The company is chaired by Mark Wiley of Wilson Bailey, and Robbie de Tooy, the South African who runs Quanta, and his partner, Andrew Davidson. What they do is they raise money from investors and usually through crowdsourcing. They then take that money and put it into bottom-end properties. So the very cheap properties where you're talking from probably £50,000, which is very cheap in the UK, up to maybe $1 million, round about there, which have been sold or are moving or being transferred or in the process of transferring, and they then have that guarantee that they can move their property quickly. It's a great business model. I went to go and have a look at it. In that sector of the market, those properties move very quickly. Here in the UK, they've got there's all kinds of other reasons without going into it, and they offer 6.8% in sterling terms. So what you have there is you have a property portfolio that is moving quickly. That's why they can offer a reasonable rate of interest. They are borrowing to put that money into those properties from a more expensive source because the big banks are not keen to, for pretty obvious reasons, to support a little company like this. You know, they want to do bigger deals, and in fact, they're competing with them. So they would then kick back, if you like, a share of the interest that they are paying, or the higher interest rate they're paying, to the investors. And with Mark Wiley from Wilson Bailey being the chairman of the company and a big shareholder in it, you really know that you have reputable, sensible people who are busy doing it. I went to go and see them. We have endorsed them. Just put Quanta into Google and you'll see. So that would be, to me, that 6.8% in pounds. But you know, a week ago, it looked like a fantastic bet at 6.8% in sterling. But sterling has dropped 10% against the US dollar. So if you had an investment instead in US dollars at 0, you would have done better than in sterling for the moment. These are very, very tricky kind of global markets and a tricky situation that we're in at the moment. Let's move on. RBM is our deep value investment. As you can see, like the others, as a consequence of Brexit, it too has fallen quite sharply. RBM was one of the biggest hit there, and that's not surprising because it has got a big exposure to Europe and then exposure to the UK as well. RBM, however, is one for the long term. I don't lose any sleep about that one. Novo Nordisk, now this just shows you how incredible Brexit's impact has been. Novo has been under a little bit of pressure lately, but it took another hit as a consequence of Brexit, even though this is a Danish multinational that sells insulin to diabetics. It's got a big chunk of the global insulin market leader, in fact, in that sector. And that's a very, very strong moat that it possesses. But when the sea goes out, the rising tide brings or raises all ships. I'm afraid when the tide goes out, it hurts all ships. And then Apple. I love Apple. I just love the company. I know it well. I'm very excited about the value that is being offered by Apple at the moment. And as you can see, it's hugely underperformed. But by my estimation, they're missing the point on two things. The investors are, first of all, downgrading or downrating Apple because of its sheer size. And secondly, they aren't paying attention to the enormous investments that this very, very secretive company has been making in research and development. It's been escalating its R&D investment dramatically over the past few years. Something's going to come out of it. They're secretive. They're not going to tell us yet. But when it comes out, it's going to be something I would bet that given the whole culture of Apple and the ecosystem that it has, is going to be something quite special. Is that the iPhone 7 that's scheduled for coming out? I think it's in September. Who knows? But it could be autonomous cars, i.e. driverless cars, which are starting to now become a very, very serious opportunity. It could be something in renewables. There's lots of speculation, but what you can be sure of is whatever the next big thing is, Apple will be right there.
Alec, just on Apple, Bruce wants to know, he asks actually, sorry, is Apple's heyday over? Doesn't seem to meet Buffett's criteria, China problems, questionable management, iPhone being outcompeted. He wonders if you shouldn't lessen the exposure to Apple, maybe in favor of the Facebook.
Yeah, Bruce, interestingly enough, Buffett's actually been buying into Apple. And his portfolios have been increasing the stake into Apple. If you have a look back at our chart, just over that last D there, that increase in the Apple share price, and this is all, these are relative graphs, we don't show the actual share price, but relative to the S&P. That was a direct result of news that Buffett is starting to accumulate Apple. So, no, I would definitely not be selling Apple shares at this point. This is your classic value opportunity, and much as I love Facebook, I would rather take money out of the S&P 500 index and put it into Facebook, and we probably will do that next month. Let's just see how you want to try and be sure. I've made enough mistakes of buying at the wrong time, and because we've only got one day that we can buy them on, we have to be sure that we're doing the right thing. On this one, though, the one thing you would not do is you wouldn't be selling Apple right now, not a single share. And that, ladies and gentlemen, is bringing us to the end of our webinar today. Just to give you the conclusion to it, when we started off here, the big bet was the Rand would depreciate. It's gone from 11.27 to 15.20. The Rand profit, as you can see, annualized 23%. So that's been the major kicker to our portfolio generally. The other, or a major kicker, the other big beneficiary that we've had was Amazon. And I have no reason, in the same way as I think Apple is offering excellent value right now, Amazon, I wouldn't be worried buying the shares today, not at all. Even though we are in the privileged position of having bought them a lot cheaper than the level they're at, there's no worries on that side. Google or Alphabet, they're starting to see enjoy the market's appreciation of a slightly different approach to the way they run the business as far as expenses are concerned. Investors love to see expenses being kept under control, and with Ruth Porritt, the new financial director there, showing an ability to do that, to bring the nerds and the techies, if you like, into line. The market likes that. Novo Nordisk has had a bit of a setback in the last little while. That's to do with some of its patents around the world, but it has a strong grip on the insulin market, and one that wouldn't be loosened lightly. The S&P 500 index is our, if you like, our bank. We just put a big part of the portfolio in the market generally for the S&P 500, and that's given what's happened in Rand terms. It annualized 21%, nothing to worry about. Berkshire's underperformed recently. That doesn't worry me. IBM is a big value bet, as is Berkshire, by the way, at the moment. Both of those have limited downside. Apple is a massive value opportunity. And in Barclays Bank, I'm expecting a pretty rapid rebound when the realities of Brexit come back. So I like the way the portfolio is balanced. We've got to find a place for Facebook, but that'll come, I guess, in due course. Stuart, that's us for today.
Yes, thanks, Alec. No more questions this side. I think it was really very interesting. Thanks a lot from this side in Joburg.
It's a pleasure, and adios from London until next week. Thank you. Thank you for joining us.